You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
In today's show, you'll be hearing from broker with Sprott Global, Sam Broom. Every 6 months, we check in with Sam for the last few years. If you're looking for a full-service broker, I would recommend speaking with Sam, and I'll put his information, his contact information in the show notes below. Welcome back onto the show, Sam. It's been about 6 months, and you are from New Zealand originally, and you've worked and lived in Australia, so you follow those markets more than a lot of my North American listeners. So bring us up to speed. What's been going on the last 6 months in regards to ASX Gold producers relative to their North American peers?
Yeah, thanks, Bill. Thanks for having me on again. Those that have been listening to me for, on these podcasts over the years will know I've long been a fan of the Australian sector in general. And it's, I would argue the Australian sector is going through a very golden period for its mining industry. There's been a lot of success stories. There's a lot of really high quality management teams in that whole space right now. So I'm a big fan. I know that view is echoed internally at Sprott. That resulted in a period of, 4 or 5 years where the Australian gold sector significantly outperformed the rest of the global market from about mid-2014 through until about mid-2019. I was going to say last year. It's 2 years ago now. Where there was an exceptional outperformance. We're talking, crazy, multi-100% outperformance if you look at the market as a whole. That stopped in its tracks in terms of its relative outperformance around about when we saw this kind of new bull market in precious metals, if that's what we want to call it, sort of mid-2019, June, July. And the reason for that, there are a whole lot of reasons for that, but the prime reason is that when you sort of transition from a sort of flat to bearish market into a bullish market, all of a sudden, leverage becomes your friend. And there are multiple types of leverage. There's, operating leverage. So, all of a sudden these higher cost producers that were sort of barely making any money or losing money are making bucket loads of money as the gold price rises, and they go from being completely beat up and potential, in some cases, potential, bankruptcy type cases to looking like superstars, and you get this giant outperformance. And so we saw a period of time where the North American names in particular, which tended to have more operational leverage, they tended to be on average, and again, there are lots of exceptions to the rule, but tended to be higher cost producers and tended to have significantly higher levered balance sheets, a lot more debt on the balance sheets. Those guys started looking like superstars. It started really outperforming. We saw some major outperformance from the North American names. One chart I like to look at just for, I'm at interest's sake, I like looking at relative performance between all sorts of different categories of asset classes and within asset classes. I'll send you a chart of the Australian All Ordinaries Gold Index, which is, basically the Australian index versus the GDX as a proxy for the rest of the market. And obviously the GDX does include Australian names too, but it's definitely heavier in the North American names. And you'll see see exactly what I said. For that sort of 4 or 5 year period, you'll see the chart going from bottom left to top right as that Australian market massively outperformed, and then about a year and a half ago you'll see it really dip down as those sort of levered plays started to really shine. The Australian sector really sort of plateaued and then declined much earlier last year towards Q2, Q3 compared to the GDX, and we saw a period where it really underperformed. Here at Sprott, we've noticed that's kind of a fairly reliable seasonal trend. It's happened more years than not. And so we often, look to, if there's anything that's significantly overvalued on the Australian side, sort of just before the summer, around the summer, we often look to trim a little bit of Aussie exposure and then look to buy it back right about now, so the end of the year, January, where that seasonal trend starts to kick in. So that's one reason why we're particularly interested in the Aussie space now. And two, it went from being sort of the more expensive, portion of the market sort of a year ago to now, we view it as the cheapest part of the market, as well as being the highest quality when you look at things like free cash flow yields. And, there's always ways, valuations are, the beauty's in the eye of the beholder in many ways. There are many ways to look at valuation. But in the ways, in the metrics that we care about the most, the Aussie market is definitely back looking the most attractive right now. Again, there's obviously individual, exceptions to the rule, but by and large, that's been an area of focus of ours in the last month or two.
So have you been steering a lot of your North American clients to invest in this market?
Yeah, I'm sure I've got a few clients of mine listening now. Chances are, if you're listening, you've probably got a fairly heavy weighting or an over allocation relative to its market size within the market of particularly Australian producers. There's obviously I can't mention specific names for compliance reasons, but they're, in our view, the sort of mid-cap through to sort of small, large cap in the Australian space on average are very, very high quality. So clients that want that sort of high quality producer, sort of, especially in the mid-cap space, a lot of my clients have a big weighting to that section. I'm not a huge fan of wholesale rotating in and out of various asset classes. So unless something fundamentally changes with these companies, I'm unlikely to recommend my clients dump them all and buy them back later or things like that. But you can sort of trade a little bit around your core positions, and then, particularly if things get way out of whack, trim some major winners and look to buy them back later and things like that. So it's more trimming and tinkering around the edges, because by and large, there's such high quality that I want to hold for long haul most of these ultra high quality Australian companies.
Do you have an exit strategy already in place in terms of a gold price? How are you judging that at this point in the cycle?
I think we're just too early in the cycle to worry about that. People say, do you have gold price target? Personally, I think it's a fool's game trying to make those kind of predictions. There is so much, as gold bugs, and I'm sure you hear it, all the podcasts like your own, and, there's so much crazy whack stuff going on in the world right now that it's really impossible to know where this trade is going to go. Or I don't view it as a trade, where this investment is going to go, where gold's going to go in the long haul, how long it's going to take. I'm fairly certain that we are, we've got a long way to run. So as long as I'm feeling, and as we as an organization feel there's a long way to run, I'm not going to even worry about the exit point. In my opinion, it's likely years away. I'm not here worried that we're hitting the top of the market. So when I start having those worries, perhaps I'll start thinking more about that. But for the time being, it's not a major concern of mine.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700 ton per day mill with an 8 million ton tailings facility ready to be used. There is already power to site and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
Outside the precious metals, what commodities have your eyes for 2021?
Yeah, so as you know, I've been a big fan of the base metals for a very long time, and 2020 showed you exactly why it's worthwhile having a diverse, or at least moderately diverse portfolio, especially in the metal space. Especially the second half of 2020, where the precious metals took a big breather. We saw things like copper, really, really take off. And it's a classic example of why you have to diversify, even despite your brain telling you that, all be in one thing. I'll be the first to admit that in the depths of the March despair, if you told me that in 9 months' time copper would be at multi-year highs, I would have laughed at you probably. But despite that, I still held, my high conviction, high quality copper names in my portfolio, because picking the timing on these things, even myself working for an organization like Sprott, where this is what we do, and it's all we do all day long. It's very, very hard to pick these things. So we're still bullish on base metals, but they're probably, things like copper have had a good run. So in terms of out and out value, that trade has kind of happened, and I do think they're going to go much higher in the long run. But in the very immediate term, one sector we're starting to look at a lot more is the oil and gas sector. That really is the contrarian sector right now for those that like that sort of thing. Everyone's different. Some people like momentum and sectors that are moving. Some prefer to play the contrarian game and buy what's obviously cheap and burned out. There's very little doubt that that's oil and gas in the energy space in general right now. I often find little weird sort of marquee moments, like, for example, ExxonMobil getting booted from the S&P 500. For those unaware, at the turn of the last decade in 2010, it was one of the top 10 largest companies by way of market cap in the world. So to go from that to being booted out of the S&P 500 is about as contrarian of a signal as you can get. You look on all these magazine covers saying the death of oil, and whenever I see those sorts of things, the contrarian in me gets a little bit excited. I have never really owned energy or oil stocks before in my life. It's not a sector that I'm personally as well knowledgeable about. I spent most of my time in my geology life before working for Sprott in the metal space, particularly precious metals and the iron ore space back in Aussie. But the setup is that compelling for those with a patient, long-term, outlook and the ability to weather a lot of volatility along the way. I think there's so much beta on offer just from owning a broad, diverse, basket of oil plays that you don't have to get too cute. You do have to be prepared to hold, though, because these things can and often do take far longer than you expect. Any precious metals investors watching this will know that well. But that's probably the most the most contrarian place that we're interested in right now.
Don't you think oil and LNG have left the station, though? Because, oil's been performing good recently, and LNG in Asia, the chart kind of looked parabolic when I looked at it just recently.
Yeah, people say that, and you've definitely missed the absolute low. I shouldn't say definitely. Who knows what can happen? But chances are you've missed the absolute low. But if you look at the producers and the services companies and the whole sector as a whole, you bring up a chart going back 10, 15 years, you can barely see the rise we've seen. It's
all about perspective.
It's all about perspective. If you're worried about what's going to happen in the next week or two, would I be rushing out to buy it? If I didn't have any exposure, I probably still would. But if I was already, if you've got a long time horizon, I think there's very little doubt that you've missed the boat. So, and that's the way I like to think, and that's the way we at Sprott, we're not too worried about the day to day, or week to week, or even month to month. We're kind of looking multiple years out, and where's the risk reward. So there's the energy space, and then one other I wanted to mention was the agricultural space. And again, I've got a chart for you. The DBA index, broad basket of commodities, threatening to break out of a 10-year downtrend. When that goes, that's going to be a very, very powerful trend. It's going to influence a whole lot of things, from inflation expectations to, it's going to affect real people, people buying, people's grocery bills going up. It's about the biggest shock to the system in terms of real felt inflation in the broad economy. So that's one I'm keeping a really close eye on. It's a very hard one to play. We've got some options. We've got a really nice farmland fund as a private fund that I like. But there are some commodity producers as fertilizer fertilizer plays, and there's just a couple of really high quality ways to play that angle. It is hard to gain exposure to, but in terms of sort of alternative asset, inflation protection type of exposure, that is an area I think, again, that's very contrarian, like the oil and gas space, that I think, investors looking for inflation protection and an alternative sort of bucket within their portfolio should have on their radar at least. So.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The flip side of opportunity is risk. So what are your key risks for this year?
For me, the biggest risk, the thing that keeps me up at night, is just the generic, or the broad level of craziness everywhere. I don't have to, everyone talks about Tesla and, tech stock, price to sales ratios. And it doesn't take a rocket scientist to know that we're in some sort of crazy everything bubble right now. So that to me is the biggest risk, because when that deflates, and it will deflate, there's no doubt about that, at least in my mind, you're going to have monster liquidity events. And, we had a pretty massive one back last year in March. Chances of that happening, whether it's that magnitude or not, who knows? But we will have that type of thing again. And we know that the way the market is structured these days, when volatility hits, it hits rapidly and intensely. It's not like back in the 30s where you have this sort of multi-year, down the escalator. It's like, you get walloped in the face, and all the negative feedback loops start feeding on each other, and it all happens in days, weeks, rather than months and years. So you need to be prepared for that. There are various ways you can be prepared for that. What I always like to tell my clients is, knowing you're in ultra high quality investments gives you peace of mind that when they get beaten up for no apparent reason other than a liquidity crunch, you can sleep at night knowing you own quality and it's going to come back. If you don't know what you own and you're sort of second guessing yourself, and do I own a bunch of crap? And, this is when the tide comes out, I'm going to get screwed and it's never going to come back. If you don't have those worries in the back of your mind, you can be firm and hold, or even use the volatility as your friend if you've got cash available to buy more. That's something I want to get better at. This is what March has taught me, is, when things get absurd, which they did in March. There's no better way to describe it, in my opinion. Having the testicular fortitude to go out and buy absolutely tier one high quality names that are trading at absurd valuations is something that everyone needs to try and get better at doing, myself included. So, that's probably my biggest takeaway for 2020. And I think I will be better at it next time around, because I'll be the first one to admit that middle of March, was I loading up the till at the absolute nose? No, I was sitting around going, what the heck is going on, just like everyone else. Thankfully, I was able to, both for myself and clients, pick up some just ultra high quality, both speculative names, high quality producers that were down, 60, 70, 80% in some cases for no apparent reason other than just liquidity.
And now they're up 300-400% since then.
And now they're up, and these are 500 million to multi-billion dollar companies, and you're sitting there with
the techs, the BHPs, the Vales, those.
Yeah, exactly. That's one fallacy that I hear a lot, is clients saying, "Oh, look, I don't want these big producers. They don't give me enough upside." Well, I'm telling you, you can get junior mining, speculative type upside if you have the ability and the sort of, again, the intestinal fortitude to buy those sorts of companies when they're really, really silly in terms of, for whatever reason. And usually it's nothing to do with fundamentals whatsoever. It's just a big slosh out of liquidity. So that's something that's a risk for 2021. But it's also going to be your biggest opportunity if it does happen. So, again, this is a rocket scientist, but
probability of it happening. Can you give us a percent based on your? Or is it just a shot in the dark? Because I've heard people say, yes, we're gonna see it again probably this year. Could be fueled by the political crisis or contention. There's a lot of takes on what could happen, but do you have any probability you could lay out of it happening?
Again, I think postulating on that sort of probability is, it's a fun game, but I think it's not all that useful. If you twisted my arm and said, pull a probability out for me, I would say it's probably greater than 50%. That we see some sort of volatility event, and by that I mean maybe a 20% plus drawdown in a matter of weeks in the S&P 500, which will flow on to what we do as well, almost certainly. I think the chance of another the event where we see the GDXJ will drop almost over 60% in 2.5 weeks is much lower than that. I think that was a kind of an event for a decade, once a decade type, or even more than that type event. But I think the chance of a very swift 20% kick to the nuts type of thing is more than 50%. But who knows? We just saw Grantham today. I don't know if you saw a piece come out from him, but I was reading through that, and he's had a pretty decent track record at picking bubble tops. And he was talking about, this may last another few weeks to maybe months. Thinking so in his mind, he thinks that another big massive crash is imminent. I'm not going to go out on a limb and predict that. It's beyond my pay grade, and I'm not smart enough to figure out the broader major macro, wanderings. But and frankly, I think I have a fairly strong view that the global macroeconomic system is just so incredibly complex. It is literally the definition of a complex system, and there's so many little butterfly effects that you just can't figure out the flow-on effects of these things, that it's very, very hard to pick. And that's why I'm not a huge fan of absolute, postulating on timeframes and probabilities, because I don't think that's useful.
Sam, I did an interview with a fund manager recently about Lithium Americas Corp, and this was at the end of December. And from about December 21st until now, so that's about 2 weeks, this stock on the New York Stock Exchange has gone up 60%. And so that's quite explosive action in 2 weeks for a stock on the New York Stock Exchange. Any commentary you can provide here, and what's your general take on lithium stocks?
I'll have to refrain from commenting about individual companies. I do get asked about the more niche commodities. I would put lithium kind of in the niche basket. It's probably moving beyond the really niche commodities these days. And I will say that we are definitely somewhat interested in lithium. Again, there are some really high quality ways to play it that aren't junior mining companies, and that's the way that I tend to prefer to gain exposure to it for my clients. But again, there are plenty of options out there, and it is a contrarian bet right now. In terms of the very niche commodities, the rare earths and things like that, I generally try and talk clients away from getting too heavy into that sort of thing. The reason being is there's just so much crap out there. Very, very few of them have real fundamental value, and it becomes a sort of gameplay and greater fool theory type of trade where you're in it because of a narrative, and all the stocks are going to go up, and you think you're smarter than everyone else in terms of running for the exit and getting out before the music stops. That's not to say there isn't fundamental reasons to own them. The whole security of supply on the rare earth angle is real. The vast majority of all rare earths are produced out of China, and everyone knows that China and the West are having a bit of a spat these days, and there is very real, I guess you could say national security concerns surrounding that. And that's obviously what's driving things like rare earths these days. But the market for me, there's not enough high quality companies out there that I'd be willing to put my capital in, and therefore my clients in for the long haul. Outside of those clients that are desperate for speculation, and this is precisely what they want to do, and they're willing to accept the risks that, the risks are very high, and they are aware that they're playing a game rather than sort of investing for the, on a fundamental basis. So,
and would another adverse reason be the fact that you're not going to have as much institutional money coming into these niche sectors versus a copper, gold, uranium? So you're basically, you're looking for the momentum retail players to sell at some point in the future. And if they don't come in, you're doomed. Exactly.
Yeah. And that tends to mean they're fairly liquid, and for me as an asset manager with, bigger book to move in and out of things, it gets impossible, and I don't want to take that risk or subject my clients to that risk. And you're right. You're at the whims of the retail market and whatever the hot flashy thing is today, and that'll be these little niche commodities for a few months or a few weeks or 6 months to a year maybe. But when the tide goes out, it goes out fairly ferociously. And, I just think there's so much opportunity out there in the resource space right now that there are other corners of the resource market I would rather play in right now.
Okay. Sam, before you go, for listeners that may be interested in your full brokerage services, just share a little about the type of accounts that you take on.
Yeah, so, we have a range of services ranging from fully managed accounts through to discretionary accounts that I advise on, non-discretionary accounts that I advise on, meaning, basically like the old full service broker type model, through to, a whole range of different private funds. So, minimum investment requirements are typically, as low as $50,000 US for fully managed accounts. These days I've got a fairly full book, so I'm, accepting new accounts in the non-discretionary advised type of account at $200,000 US and above. But anyone that's interested in the mining space and investing with the help of an industry professional to really guide them through their investment process, I'd be more than happy to talk with you and see if what we do is right for what you're doing with your portfolio, and if we might be a good fit.
And Sam, I should also mention, is a geologist. So he's good with the early stage exploration plays and advising people on that. So he's good with the charts, understands the markets, and he is a former geologist. Sam, really appreciate you coming on the show, and we'll be checking up with you in about 6 months.
No worries, Bill. Thanks for having me on. It's a pleasure as always.